After helping many people make that transition from that accumulation phase of life into what we call the distribution phase of life, something that has come up time and time again is how can I create the best portfolio allocation across my different accounts relative to the income that I need in retirement? How can I position my portfolio, compose my portfolio in such a way where it can reasonably support the income that I need each and every year throughout retirement? And so I think the best way to illustrate this is to go through an example of the bucket investment strategy, the exact investment strategy that we use here with our clients as they make that transition into retirement. So let's say you've done your due diligence. Let's say you've gone over your income in retirement. And you figure out that you're going to need $40,000 per year from your portfolio to support the retirement that you want to live. So the way this works is we're going to bucket our portfolio. For the sake of this example, let's assume that you have $1 million portfolio and you're going to pull out $40,000 each and every year, 4%. Let's take a look at bucket number one. Bucket number one in our bucket investment strategy is our liquidity bucket. These are funds that we're going to need in the next 0 to 3 years. Hence the name of the bucket, our liquidity bucket. And in this bucket, our funds will be in high yield savings accounts, short-term CDs, money market funds, or cash alternatives. As I mentioned, we want 0 to 3 years in this bucket. If we assume that we need $40,000 per year and we want to be as conservative as possible, then it would make sense to have $120,000 allocated to our liquidity bucket. Now moving on to bucket number two. Bucket number two is our manage risk bucket. These are funds that we won't need for the next 4 to 7 years. And for the sake of this example, let's just assume that we pick 5 years. And so in this bucket, we're going to want $40,000 times 5, the amount of years that we want set aside. And we see here that we'll get $200,000. And now in this manage risk bucket, we are going to be invested into things like dividend-paying stocks and bonds. The goal of this bucket is through the dividends we receive and the interest off the bonds, we will refill bucket number one as we take funds out of bucket number one. And then finally moving on to our last bucket, bucket number three. This is our growth bucket. And these are funds that we won't need in the next 8+ years. And it's easy. The rest of our money, the rest of our portfolio gets allocated into this bucket. And so if we look at bucket number one, we have $120,000 in bucket number one. If we look at bucket number two, we have $200,000, assuming 5 years. And so the rest of our portfolio, that $680,000 would go into our growth bucket. We aren't touching that $680,000 for at least 8+ years. And bucket number three is going to be invested in growth-focused investments. Think stocks. So guys, when we talk about the bucket investment strategy, it is important to remember that the way we're allocating our funds, it's not that we can't access these funds for 5 years or for 8 years. It is simply the fact that we want to make sure that these funds are funds that we don't need. If we go into a down market, if there's turbulent markets, if there's volatility, we don't need to pull the funds from those buckets to then subsidize our living today, because those funds to subsidize our living today should already be placed in bucket number one. Therefore, we are not having to liquidate any investments in bucket number two or bucket number three at a loss, locking that loss in. So guys, this is how in practice our investment bucket strategy works. And as you think about retirement, it is crucial that it is more than just the individual investments that you own. It is more than just where are those investments held. It is crucial to have a retirement plan that takes into consideration everything you have going on. From what it is that you actually want to do in retirement, from the income that you have in retirement, whether that's Social Security, income from a business, real estate, or from your portfolio, your monthly and annual expenses, your assets, your liabilities, and then how much do you actually need to pull from your portfolio to subsidize that income gap if there is one? And just as importantly, how can you create the most tax efficient income withdrawal strategy in retirement so that you too can keep more of your hard-earned money in your pocket? Guys, this is exactly what we do. And I invite you to schedule your retirement income strategy session below. Click that link. You'll be able to schedule a meeting with me, and I look forward to working with you. We'll see you soon. Thanks.